I'm Drew Stevenson, and this is a lecture for my Law and Economics seminar about the concept of adverse selection. This is an idea or concept that comes up a lot in the context of insurance contracts and insurance law, but can apply to a variety of situations where we have a risk pool or risk management type of program or some sort of legal device that shares the risk, like indemnification. So insurance and other risk management pools determine prices and break-even points based on the statistical likelihood in general of the relevant harm occurring. So if you're insuring against, like you have a life insurance policy that insures, has a payout when you die, or health insurance that pays for your medical bills, or homeowners insurance that pays when your house burns down. And basically they calculate the statistical likelihood of that event happening so that they can price everyone's premiums and then have enough money coming in so that they can compensate victims when they suffer the harm that's covered under the contract. But unfortunately, some people like risk more than most of the rest of us. And high-risk individuals are disproportionately likely to opt into insurance pools or other risk management programs. And this is called a selection effect or a screening effect in economic jargon. And so the idea is if you're elderly, you're more likely to be interested in having a life insurance policy than if you're young and feel healthy. If you're a little bit sick or you have a pre-existing medical condition, you're more likely to want to buy medical insurance that would cover all of your medical bills than someone who never goes to the doctor because they don't need to. And so the fact that people select into risk pools skews the aggregate risk of the pool higher than was anticipated when they looked at basically just the generic statistical likelihood of the accident. And so insurers will try to mitigate adverse selection. For one way is to ask a lot of risk-related questions on insurance applications, like do you smoke? Do you ride a motorcycle? Do you play golf on high-rise I-beams, like pictured in this photograph? And so if you've bought a life insurance policy or a health insurance policy, you've probably been asked things like that. If you have a homeowner's policy, they may ask you questions like, how often are you gone for weeks or months at a time? And do you smoke in bed and other types of things like that. Also keep in mind that government-run risk programs like Social Security or Social Security Disability are often mandatory for everyone in order to offset the high-risk individuals with low-risk individuals in the risk pool. This was the rationale behind the individual mandate in the Affordable Care Act, for example. So adverse selection is similar to moral hazard in that both distort the risk pool and cost, but moral hazard sets in after the risk is insured in some way and can apply to anyone in the risk pool, while adverse selection is kind of an ex ante problem about high-risk customers who self-select into a program. So I want you to imagine for my students, this is going to be sort of a silly example, but it illustrates it poignantly. Imagine that your law school offered an insurance program if you fail the bar, right? So they'll refund your tuition if you fail the bar, or they'll refund the cost of your bar prep course. Let's say if you fail the bar, and 10% of your law school tuition. Just humor me. Well, on the one hand, if we make it too high, if we'll give you all of your law school tuition back if you fail the bar, it creates a perverse incentive for people to try to fail the bar, right? Because that's a big payoff. But it also, even if we modify that and make it just a small compensation if you fail the bar, the people most likely to sign up for that are the people that are kind of worried about failing the bar, right? So not the people at the top of the class, but the people who know that they're at risk or know that they are not really prepared to take it and pass it on the first try. And that's the adverse selection problem. Notice that adverse selection can occur outside of government, outside of insurance markets. So with moral hazard, we talked about government bailouts, but we can also talk about adverse selection in the context of the government bailing out in an industry like the investment banks or the automobile industry. Why? Because the parties most likely to engage in reckless activity are going to line up when there's a bailout. There can be adverse selection effects with borrowers in the corporate lending, commercial lending context. So if you think about banks that lend to business, and this could be individuals or corporations, that a lot of there could be a correlation between how risky someone is, like how likely they are to default, and how desperate they are to borrow money, right? So the more desperate you are financially, the more you want people to lend you money, whether you're a business owner or an individual, but you're also more likely to default. And so when if you're a commercial lender, you have to have some pretty sophisticated screening. Otherwise, the people who are most likely to default are going to want to borrow the most frequently and for the highest amounts. And the people who are most likely to pay you back are least likely to need a loan, ironically. Think about public relations firms, right? So who's most likely to hire a public relations firm? Well, some large corporations are always going to, or a politician may hire a public relations firm, or a celebrity or someone like that, no matter what. Maybe it's just an industry standard that you have a public relations firm. But there could be a selection effect, right? An adverse selection effect where the people who are most likely to need to repair their reputation might be disproportionately likely to hire a public relations firm. How about referral services to get new customers? This could be law firms, this could be hair salons, it could be HVAC service companies or something like that. But if you aren't getting enough new customers just because of word of mouth and advertising and your reputation, then you may sign up for some of these services where people call and they refer them to you as one of the local service providers. And so the question is whether a referral service could pose an adverse selection problem. I'm not saying that everyone who uses a referral service is going to be a substandard service provider when they get customers, but the fact is that maybe the people who the entrepreneurs or businesses who have trouble getting customers and are most likely to need a referral service to get customers in the first place are the ones that don't have a very good reputation because they provide substandard service. Think about court appointments for lawyers. Now, I'm a big fan of court appointments for indigent defendants. I think that this is guaranteed under our Constitution. I don't think people should have to go it alone in court, so I'm not critical of that. But the fact is, if lawyers get to sign up to get court appointments to represent indigent defendants at some standardized hourly amount, there could be an adverse selection effect where the lawyers who have the hardest, who are most likely to sign up, are those who can't get their own clients because they don't have that great of a reputation, right? So if you already have more clients than you can handle, you're less likely to ask the local court to put you on their list so that they'll refer some business or give you some cases to represent indigent defendants. And so the concern, as a theoretical matter, I'm not criticizing people that are appointed counsel, but there could be a disproportionate number of people who sign up for this who are having trouble getting clients on their own, and there's a good reason for that. And that concludes my brief lecture about adverse selection and what I think law students need to know about it.